All right, let's take a look at this Bitcoin halving and what has been going on with all the monetary assets. We'll take a look at gold and silver and Bitcoin, and that'll probably do it. Dollars aren't interesting right now. So I'm looking at Bitcoin here. So we had the halving on the 11th here, and we had this interesting high volatility bottom, and we've been headed up since the halving. And for Bitcoin, I think we should get out to sort of this view and take a look at exactly what we have been seeing. All right, so what we have here is a pretty basic, pretty clean wedge shape here, and it looks like we got a big reversal off of this leading into the halving, and then we have a support bottom edge here. And so right now it looks like we are at this support zone. And so for me, Bitcoin has still not been acting like money in this entire credit contraction cycle that we're in. And I would definitely want to see Bitcoin get out here and start using this area as support before trying to indicate any kind of big move up for Bitcoin. But we just had the halving, so that means the supply of Bitcoin is going to be restricted even more, and that should be uh, positive for the price of Bitcoin. It has been in the previous halving, but there's been a ton of buzz and drama about the halving, and it's not like a big secret this time. And each time you do the halving, it's less and less effective because there's less Bitcoins coming into the supply each time anyway. So here is where we are now. And so if we drive up again to this line, this is a hot spot, and see if we get reactions and reversal out of here. And a reversal out of here could very well send it down to this area again, and then and then we could kind of get this kind of thing. Who knows? And it could be a much later move to the upside or downside later after some more consolidation. And so that is the look for Bitcoin right now. And we're near a major kind of resistance area, and we've already gotten rejected off of it once. And the last times we rejected off of this thing, we didn't quite make it back up this high, lower high, lower high, lower high, lower high, lower high. So it's entirely possible that we kind of just trend down and then drop. So if this starts trending down and we get sort of this kind of dead cat bounce area that we got on the last kind of rejections out of this zone, you could see a pretty aggressive drop across down to the bottom side. And so I think the downside, the size of a downside move is much bigger than the size of an upside move. The upside move, you're just trying to get outside this consolidation zone. And so just the asymmetry and probabilities here, I don't know the percentage chance that we do either one, but just the size of the move is a much bigger downside move risk than the upside here to break out. And plus, if we broke out to the upside, probably would turn this into support first before you got out. So that makes the upside even smaller here. But then we just had the halving, so who knows? This thing could, it's Bitcoin. It could do anything. It could just like go straight up to a million or something. And so let's look at Bitcoin. And I wanted to take a look at gold and see what gold has been doing here. This is the GLD, which is the Spider Gold Trust. And I always recommend against the GLD because HSBC is the custodian, and that is one of these basically bankrupt international banks that's in a world of trouble right now in this international monetary contraction. It's an international banking crisis. That's what this crash is. And these international banks, the GLD, I just saw an article like do they even have the gold that backs this thing? And how are they storing it? And that's a really risky custodian. And I think the GLD is very risky. And there's a couple other options. There's like the PHYS, the Sprott Physical, or like maybe the Schiff, Peter Schiff. But I was holding gold overnight last night, and I was holding this one. I don't even bother with the GLD overnight. I definitely would not ever hold the GLD long term. And so what we're getting here on on the GLD is a big bull pennant, and we got a big breakout here, and this could continue. And then the thing that's happening though is it looks like the contraction and the downside of the stock market is coming on right now. And every time that the stock market goes down, people sell their monetary assets, their gold, their silver, their Bitcoin, on margin calls to cover losses in the stock market. And so that pulls down all the monetary assets with the stock market crash. These monetary assets come right down with the stock market when it crashes. So there's downside risk in the cycle and in the stock market that's completely tied to the monetary assets. And these aren't just independently just floating up on their own. But it looks like they want to go up, and that the gold is really acting like money in this entire crash. It's bounced. Oh yeah, this is interesting. So here's the whole crash here, starting Feb 20, and gold popped up to start the crash and then sold off, and then bounced really hard on the dead cat, and then let's just get the S&P in here and see the exact turnaround points and see if gold is an indicator. I think it might be. It looks like gold is jumping before the crash and then pulling down with it. So Feb 20 here, yeah, see gold pops up and then pulls down. And then the up move outlasted the dead cat, and then the bottom was early. Okay, so it's pretty close. It's pretty close, but it got an initial pop before people really figured out the market was crashing, I guess. And it looks to be pretty tight with the up and down moves of the S&P here, but now the S&P is trending down and gold is trending up against it. So we're kind of getting a divergence, but if this rips down, this probably will sell off with it. And we might be seeing the same thing here where we get a little pop before the rip. And the rip may have started here already. And gold is getting that little pop now. So I think gold is pretty risky, and holding it over this weekend, if the market does turn over and start ripping, there could be. I just think the downside on gold is much bigger than the upside here, because I mean the upside you're just kind of wandering up. It's pretty gentle, but if you do get a credit contraction, rip to the downside, gold sells off pretty good. I mean, it's not a huge sell off like the whole stock market sold off, but I mean, I don't have the numbers because it's on percentages here. But let's get this S&P off of here and let's check out the actual numbers. So, I mean, it's a tiny percentage. So it wouldn't be that huge of a rip because, I mean, the whole stock market crash 158 to 138. I mean, whatever that is, that's only like a 10% move down, and then you get like a big move up back to above where it started. So gold in general has been trending upwards through the whole crash. So this is a really good long in a credit contraction cycle. Generally, gold is a good long, and it is a good long in this cycle, but it does pull down when the stock market pulls down, and there's a big risk of that right now. So I don't know how far it would pull down. Probably less than this one, maybe back down to here or something like that. And then gold would be a really good long again after that, till the end of the cycle. And then at the end of the cycle, we would switch into a growth expansion phase where gold would become probably uninteresting and people would still be buying it because it looks really good. And I would expect gold to possibly even go down through this next expansion phase, because that is not the whatever the fundamentals for gold. That's not the cyclical type of the contractions, and then maybe stagflation is where gold does okay. But in a growth phase, gold is not really a winner. So that's kind of the outlook for gold out through this cycle is some downside risk right now, and then it could be a really good long off the bottom of that thing until the end of the cycle and try to figure out if there is more cycle off of the next down or when the cycle is ending. We'll have to see what the cycle looks like. And then SLV has actually gone crazier than gold, which is very interesting because silver thus far has not really been acting like money in this crash. So you can see here Feb 20. So yeah, silver got a little bit of a push up at the beginning of the crash for a couple days. But then it really crashed with the S&P a long way. 17 to 10, that's a big down move for a monetary asset. And it just hasn't gotten that back. I mean, you saw gold was up above where it started. Silver's like halfway. And it is doing this interesting thing. We get a sort of a consolidation zone. Maybe this whole thing or this kind of a wedge here probably makes the most sense, but we have broken out of that wedge and we're getting a big move up here. So that is an interesting look for silver. That means silver is trying to act like money, but it's also a commodity and it has way more exposure to the downside risk than gold does in this contraction. And a monetary contraction cycle is not generally good for silver. Silver does better if you have a contraction and you have positive growth. Then silver is in a better kind of space where commodities do well, and silver does good as a monetary asset and a commodity in that specific condition. And I don't foresee that combination happening probably for at least a year, because it looks like we're going from a contraction to an expansion to a stagflation to another expansion from the financial data that I have right now. And so, yeah, this is interesting, and it's the same thing. Like the stock market looks like it started pulling down here, and then we get this pop in silver and gold, and I think this, yeah, I mean, I saw the fundamentals swinging up last night, and I held some gold overnight last night just because I thought it would see if it would open, and it opened a little higher today. Silver would have been a way, way better overnight kind of play. I didn't expect silver to pop like this, but I think this is a really risky spot, and this is a high parabolic kind of, that's a place to sell if you're holding it, I think, because it looks like the stock market already started moving down here. And if we get that credit contraction down rip in the stock market, the downside is really big here. And I don't know how big the upside is. I mean, I don't know if this upside move here is in reaction to the stocks coming down or if it's in reaction to all the dollar kind of situation. I mean, we have China and Russia trying to say that the dollar shouldn't be the world reserve currency this week, and people are kind of freaking out about inflation and things like that. And I did a DXY video talking about all of that just a couple videos ago. But it really looks like it's not that huge of a concern. And it's interesting to see silver do this little pop right here. And yeah, China's talking about maybe they're going to default on their dollar debt. And I mean, that's possible that some countries that get in trouble could default on a little bit of debt. But that's why America's trying to create enough liquidity to keep these loans open so that people don't default. That's what the helicopter money is, to help people pay their debts, their school loans, their car loans, their house loans, all this stuff. The Fed is just trying to keep the banking system operational. They're not going crazy and just blowing crazy amounts of money at everyone for fun. It's just loans that are due, and the contraction makes it really hard to pay loans. So that's why you see the banks have these huge funds to handle defaults. And that's why the Fed is basically creating this getting this money to help with defaults and help people to continue to pay their loans. And so far they've been avoiding bailouts and they've been buying corporate bonds to try to create more liquidity for the companies to continue paying their loans and not need a bailout. But I think they'll fully bail companies out if it becomes necessary. And they just announced that they're going to be buying junk bonds on top of the investment grade bonds. So that, yeah, that's big news. And just all the stuff that you see with the banks, like getting ready for a huge wave of defaults right here. I mean, that's part of this credit contraction cycle, and that's exactly what I'm talking about. Like the credit cards are extending less credit, and you need higher credit scores. Housing loans are becoming less available. Like there's no more jumbo housing loans, and they're cutting off HELOCs, like home equity lines of credit now. Like they're cutting off credit and they're making it a lot harder to get credit. And it's just the world monetary system contracting. And that's why the Fed is trying to keep things working. And so, yeah, this thing looks very suspicious to me. I've seen some technical people saying like this breakout is a huge bullish sign. And I think this is a false pop. I think this is a fake little swing, just like we got during the first crash. That's exactly what we got right here before the first crash is we got this fake little swing up, kind of parabolic swing up right before we crashed. And I think I'm sure not going to be holding gold or silver over the 2-day weekend here. No way, because that's a lot of time for this credit cycle to continue swinging down. And I think that we could see a pretty ugly opening next week. And I mean, I don't have any long positions except volatility and dollars at the moment. And I'm just trying to kind of adjust my positions for the weekend. Like financials look really bad right now, like the XLF. And this is what I've been shorting today, trying to position for the weekend. Just because the cyclicals are looking really bad on this one. And what's the Russell? I always forget. IWM. Yeah, the Russell. So I was shorting these two today, trying to get ready for the weekend because those ones looked like they were not even trying to move up right now. Some of the other things, like some of the tech stocks, look like they're trying to move up. And I think that those are the main things I was trying to short today. I was looking at Twitter was one of the tech companies that didn't look that good. And oil is just really tricky right now because we have these mid-month contracts coming up. But the technicals for oil look like it's trying to push up right now. So I'm not comfortable trying to short it right now because it could swing up a little bit more. But there is some downside risk on the oil things. Just because of the mid-month contango, all that nonsense. And yeah, I guess like I was looking at this one, the emerging markets. This is the spider emerging markets, and that I think has a lot of risk as far as the international banking defaults are concerned. That would really affect the emerging markets. So those were the shorts I was looking at today. I think the industrials, QQQ, those are still looking pretty difficult to short. The cycles are kind of doesn't look like they want to turn over right now. They're on a higher trajectory, and I mean they do have a lot farther to fall, a lot farther distance to fall. But I just didn't like how they looked right now at close. I mean we're getting close to close here, and the XLK is just it doesn't look like a killer good short today. Just the way that it's swinging, all the cycles on the different levels, like the daily candles, the weekly candles, hourly, like the 15-minute candles. If you jump in between all the views and just see how they're trending, these two are trending down already, and they look like they're in the most trouble, but they don't have that much room to fall. And same with the emerging markets, but XLK and the QQQ have a lot of room to fall, but I already have a little bit of exposure to these ones, and I didn't want to get any more today. And so that's kind of the shorts that I'm looking at. And yeah, the monetary assets. Yeah, the only monetary asset that I like right now coming into a potential contraction and a crash is dollars. because gold and silver pull down, and Bitcoin has also been doing that. So let's go back to Bitcoin and look at it. So you can see here, where are we, Feb 20 here. So yeah, this is interesting. Like this crossover from end to end, we didn't get up here. So that's 10. And it was already coming down by the 20. So I don't think the contraction is what pulled Bitcoin down off of this peak here. But the contraction definitely helped this sell off here. And a contraction could definitely accelerate this sell off here. If it flips off of this and we get a contraction, Bitcoin could come down quite a lot, like in half. Wow. Yeah. Bitcoin could jump in half in, well, I don't know if it'll get all the way down there right now. I mean, something like this. I don't think it'll rip that far. This is just a downside target if it starts going down, but I don't think that's a downside target for like the next month. That's too fast. But you can see that Bitcoin does this dead cat bounce and this rip and this kind of the whole shape of the S&P. Bitcoin did it. It sells off with the S&P, so it's definitely at risk of selling off along with the other monetary assets. And so I see a lot of downside risk on Bitcoin and the other monetary assets right now. And Bitcoin, interestingly, reversed down before the halving, and we haven't quite gotten back up to that point yet. So I don't even know what it's trying to do right here. I mean, this could be a like a bull kind of pin it consolidation where you pop. It does look like that, um, but there's a lot going on. So I just don't trust Bitcoin at all at the moment, and it really has not been acting like a monetary asset during this crash. Like it really crashed with the crash, and it could do it again. And it hasn't been rebounding. Like it did make a pretty good jump here, so I guess silver and Bitcoin are semi-monetary assets. They're acting a little bit like monetary assets, but not like gold is. Like gold is up, up, up over the crash, the whole crash. That's what you want to see for a monetary asset in a down cycle. Um, yeah, I guess that's good. Oh yeah, subscribe button and like. I always forget to say that stuff. And if you get in the comments, I'll chat it up. I think that'll do for this one. I'm gonna go check out and see if there's any other moves I want to make before the market closes. And this is not investment advice. Happy trading.